When stocks make huge moves, the options derived from those stocks normally behave in a certain way that gives rise to really significant trading opportunities. I'm Seth Froberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the traders on our proprietary trading desk are keenly aware of how options prices change when a stock makes a giant move in either direction. In today's video, we're going to be covering the details of a very straightforward options trade that can easily emerge right after a stock makes a really big move over a short period of time. The kinds of moves that are taking place across a broad swath of stocks right now in this volatile market. So if you'd like to learn this simple to understand concept, then stick around because I think you're going to be able to easily add this to your playbook. Hi, I'm Seth Froberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world trading, both remotely and in our offices here in New York City. So I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so it's like a switch was flipped on New Year's Day, and the market, which had been on a raging bull run since the bottom of the pandemic crash in March of 2020, decided to pull back into a somewhere between a correction and a bear market, depending upon which index you're looking at, which isn't surprising after a run of that length and magnitude. And as you can see from this price chart of the S&P 500 index, by early March, the index had pulled back 13% off of its highs with no signs of letting up. And as some of you may know, gold has traditionally been considered a hedge against the stock market. And so it's no surprise that at this time, gold prices started to rally over that same period of time, as you can see from this price chart of gold futures, which rallied strongly during this exact same time period. Now, before we get into exactly how this movement in gold constitutes an options trading opportunity, I wanted to let you know that if you want to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade, even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That's going to open up a free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. So now, as some of you may know, gold mining stocks move in a highly correlated way to gold prices themselves. And so if you want to take advantage of price volatility in gold, it's easy to do so by trading gold mining stocks, and specifically Newmont Corporation out of Denver with the trading symbol of NEM is one of the more popular gold mining stocks for equity and options traders. So now I want to do a really quick review of how options on stocks work so that everyone watching this video understands how they can be used to trade gold mining stocks. If you already know how stock options work, just please hang in there. This is going to be quick. Okay, so what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go way past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below market. He could flip them the next minute and make a huge profit on those shares in that case. Or conversely, as to the put option, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put, which effectively puts a floor on how much he can lose owning that stock. On the other hand, if on expiration day the stock closes below the strike price of a call, unless it was previously exercised, the call expires worthless and the call seller just pockets the premium. Similarly, if you sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it expires worthless and the put seller just pockets the premium. Okay, so keeping that in mind, let's take a look at the price chart of NEM, Newmont Mining. And as you can see, it also rallied in the first quarter of 2022, hitting its all-time highs on March 8th, touching a price of 80 at one point during the day before pulling back. You'll also notice that on that same day, the stock had a spike in what is known as its options implied volatility, which is basically a measurement of how much the prices of options are being bulked up by the anticipated move in the stocks they're derived from, which is the risk that option sellers are facing, so that the more volatile a stock is expected to act in the future, the more the pricing of those options is bulked up, and the higher the options implied volatility will go, which is quite high in this case on March 8th for NEM. The implied volatility of NEM spiked over 50, which is a very high reading for that stock, and that is key to this trade, as you're going to see a little bit later. And so let's say at the end of that day, when the stock pulled back to around 77, and with the options volatility so high, we went out 37 days into the April 14th options expiration chain, and we went ahead and sold 40 of those 90 calls, 12.5 points above where the stock was trading, and went up 5 points further and bought 40 of those 95 calls. Then we moved to the put side and sold 40 of the 65 puts, 12.5 points below where the stock is trading, and further bought 40 of the 60 puts further down. So if we had done that on that day, we would have executed what options traders refer to as a 25-point wide iron condor around the price of NEM, which was, as I said, trading around 77 at the end of that day. Okay, so let's first understand the cash flow that has just taken place once we do this. And as you can see, the 90 calls were going for $1.25, but remember, each of those options represents 100 shares of NEM stock. So you multiply those by 100, and we sold 40 of them. And so the total cash flow we received was exactly $5,000. But remember, for protection, we buy the 95 calls with a price of 79 cents, which costs us $31.60, as you can see from the calculation. Similarly, the 65 puts brought in $3,200, and the protective 60 puts cost us $13.60 for a total final positive cash inflow of $36.80 when you net it all down. Incidentally, the maximum risk you have on this trade is $16,320, which is exactly what your broker will require of you in capital if you wanted to execute this exact trade. Okay, so now let's move forward to the day that these options expire, which is on April 14th, and you'll see that NEM continued to rally, blowing past its all-time high, closing near 85 on April 14th when the options of this iron condor expire. And so let's analyze what's happened to our iron condor on that day, because on the day that these options expire, each of the options are given a final value as it will appear in your broker platform. And so let's analyze this situation. So starting by reminding ourselves that we've originally received that $36.80 of cash flow for selling the iron condor in the first place, then if you think about it, the two calls at 90 and 95 have no value because the stock closed at 84.77. So you wouldn't obviously exercise a call to buy the shares more than $5 higher, and so those both expire worthless. And similarly, anyone holding the puts down at 65 and 60 certainly wouldn't have any incentive to exercise their right to sell their shares at 65 or 60 when the open market's offering $84 for those shares. So those expire worthless as well, leaving you with that original cash flow of $36.80, which you just pocket because the trade's over and none of the options have any value. Okay, so now before we bring this to a conclusion, I wanted to make one really important point to you. You remember how we discussed that spike in implied volatility in NEM on the day we entered this iron condor trade? Well, you might be wondering what that same trade would have looked like in a low implied volatility environment. And that's easy to do because just 1 month earlier on February 10th, when NEM was trading at 60, the stock's implied volatility was much lower, down at 35 versus the 50 level when we initiated the iron condor that we just shared with you, that March trade. And so if on that day we had initiated an apples for apples iron condor where the short calls and short puts are 12.5 points from the stock's price and the protective options on both sides are 5 points further from NEM's price, then if we were to break down the cash flow from this same trade done in lower volatility times, you'll see that we only receive $720, where just a month later, we received more than 5 times that amount of premium for the same trade right after the implied volatility spiked in early March. And so what I'd like you to take away from today's video is that when a stock has a spike in implied volatility like NEM did last month, there's a terrific opportunity to create a very wide iron condor trade that pays you handsomely for the risk and generally carries a pretty high probability of success because of that width. Whereas the same trade is quite a bit less attractive in a lower volatility environment and the potential for a big payday just isn't there. Pro traders track these volatility spikes and are well trained on how to leverage them into profitable trades. And now you've got that knowledge too. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can head on over to optionsclass.com to register for this free workshop. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it. Oh, and please don't forget to hit our subscribe button right now so that you don't miss any of our free training videos to help you up your game as an options trader.